And the reason that I call it that is because the statistical deviations, the different ways that we have been pencil whipped by the bookkeepers in DC have shown a much stronger job market than we really have. As we've talked about over the last couple of weeks, the actual numbers, if you take out the statistical deviations, the adjustments to employment numbers, the adjustments for population control, show that we lost 2.5 million jobs. That's right, a 2.5 million job loss. But the report is showing almost 900,000 jobs increased. And a lot of the folks in the market, especially with computer trading, they're not digging into the guts. And because they're not digging into the guts, the economy is looking a lot more bullish. We've had a couple of other things that have happened as well. Our CPI results, the consumer price index results that we received this week, were not quite as favorable as we were expecting. Part of that, however, is due to, very simply, it's due to the way that they've changed the weighting. What they've done is they basically made the housing component of the consumer price index a larger component of what they're measuring. So the CPI only went down 0.1%. They were expecting 0.2 or 0.3%, but housing expenses, because of rent increases that have happened over the last year, because of higher interest rates, higher home prices, the housing prices portion of the consumer price index has been weighted a lot more heavily. Now, does this mean that our projections over the next few months are going to be changing? No, not really, because over the next few months, we're going to start seeing smaller increases in the housing price components, as well as smaller increases in other components of the CPI. That means, because this is a rolling 12 months, that we're going to see the inflation number come way down. So May 10th is really the day that we see the start of that. But we think that we're going to see a lot of relief in the next 2 to 3 weeks from upcoming CPI numbers and from the next jobs report. One other thing that we're looking at is the fact that bonds are grossly oversold. Grossly oversold. The bonds have been testing the 10-year treasury has been testing another ceiling, and it's held before. The fact that bonds are so grossly oversold, when we get a small piece of good news that is favorable, we're going to start seeing that oversold position is going to correct itself. That means that rates are going to start dropping again. What is coming up? The next week, we're going to have the Fed meeting minutes come out. We've also had three of the Fed Board of Governors are talking really hawkish. They're saying, hey, we wanted a 0.5 point increase last time with this bullish data. We want another 0.5 point increase. That's probably not going to happen. We're probably going to see another 0.25 point, maybe a second 0.25 point increase. And then the Fed's likely going to be done unless we get some really anomalous data. What is happening in the Houston market? I'm going to tell you, the Houston market, it amazes me. New listings are only down 3.2% from the same week last year. So that's really good. Last year at this time, in the last week that we had, there were about 2,585 new listings. Right now, 2,503 new listings. Pending listings are down 22%. We understand that, especially as we've had that little increase in interest rates over the last couple of weeks. Off-market listings are way up. They're about 64% over last year. And when we see that, we understand, some people are getting frustrated. They cannot sell their homes at the same prices that they were able to sell them for in July of 2021. They think that, there is a train of people following realtors around, that the moment the sign comes in, you've got 20 folks wanting to write an offer. HAR listing views, they were down about 40% year over year. That's one of the worst weeks we've had in quite a while. It was 20-something percent, up to 40%. Now we're down 40%. I think that has a little bit to do with interest rates and folks being a little bit afraid. Here's one of the things I want to share with you, though. When you're trying to buy a home, you lock in your purchase price the day that you buy it. So right now, as there's more fear in the market, this is a great time to buy, especially as sellers are afraid. You have the opportunity to negotiate a little bit more. So when you lock in that sale price, you're in great shape. And then when the markets drop, you are going to be able, when the interest rates drop, you're going to be able to refinance your home. In fact, at Cross Country, we're going to waive our lender fees for that. And in Texas here, you get a very significant discount on your title policy, so that the cost of the refinance is going to be significantly lower than normal. That'll help you save money. So the idea is you buy right now, buy fear, sell greed is what Warren Buffett says. So you buy right now and you're able to get in touch, get your property at a good price. You can even get the seller likely to pay some closing costs, and then you refinance when rates go down. If you've got any questions, give me a call. Rich Bond with Cross Country Mortgage, 281-841-1723.